Goldman Sachs has reported better than expected first quarter results, boosted by a surge in equities trading revenue and profit. Let's get more from Stephen Biggar, Director of Financial Services Research at Argus Research. Stephen, it's great to touch base with you. We've talked in passing about these Goldman numbers with a couple of other guests, but it's great to take a more extended look at them with you. What stood out for you in the results from Goldman?
Yes, good morning. It's well, certainly the trading revenues, right? We're kind of the star of the show, and it's what we've seen from some of the banks that reported already. J.P. Morgan on Friday, Morgan Stanley, and now Goldman this morning. So it was just a very volatile environment, clearly, for not just equities, but fixed income, currencies, commodities, and a lot of repositioning trades as well, which is beneficial. So banks don't benefit generally when markets just kind of grind slowly higher or even slowly lower. But clearly these repositioning trades. So that was one thing that stood out. It did overshadow a bit weaker investment banking revenues, and clearly a lot of the call in the future is focused on that. The trading revenues certainly can stay high through the second quarter and beyond. But the market really doesn't give a strong multiple to trading revenues because they are volatile, and so we're really looking for that improvement in investment banking, and that's where a lot of the call was focused on. Are the phones going to start ringing again? Is a big part of this, and clearly the management talked about the conversations remaining constructive, but their corporates, their clients are on hold until they get a little more clarity on tariff policy.
And how candid were executives at Goldman at putting it that way, that tariff policy is the source of uncertainty that our clients want to see cleared up?
Well, the political aspect of it is that they're, it's a wait and see approach. I mean, they're there for their clients when the clients are ready. They spoke about the long history, obviously, of Goldman and being available for clients in all types of environments. And, they want to stay where they're at in terms of those constructive client conversations. And the same for Morgan Stanley and J.P. Morgan. The banks don't really see this as lost revenues. They see it as delayed revenues. So it'll occur. This improvement in banking revenues we really didn't expect to see probably until the fourth quarter of this year. The new the administration change in the U.S., which was expected to kind of marshal in this big improvement in advisory and IPO activity, clearly on pause. But it takes 9 months generally for the banks to get paid until the transactions go through. So this was always a late 24 activity for them, and clearly we're pushing that more into 2026 at this point, given that conversations are unlikely to start until late in the second quarter at the earliest.
When Donald Trump was elected back in 2024, immediately the market bid the U.S. banking stocks up on the thought that regulations would be eased, and part of the takeaway there would be that M&A would become easier to accomplish from a regulatory point of view. Does that story remain in place, in your opinion?
It does, but again, delayed because we have not seen the ramifications of that. So, yeah, I'd point to two things on regulation, and the first, as we talked about a bit here with M&A activity, and that is again an easier time through Federal Trade Commission approvals, Justice Department not putting up any fights in terms of companies merging. So. That is obviously you need these conversations to remain constructive and get those deals on the table before the banks will realize those revenues. So we just haven't seen that play out yet. There haven't been enough proposed acquisitions to get to the desks of the FTC and Justice Department. The second thing is for bank regulation would be on the capital requirements. And again, there we haven't seen a lot of motion. In fact, just a few weeks ago, the President Trump named Michelle Bowman as the vice chair for supervision. So that's really where a lot of that activity will take place. So that's a fairly recent entry into the game here in terms of capital. So if banks have an easier time with capital requirements, it frees up capital for not just for lending, but of course for stock buybacks and dividends. And we'll get a kind of taste for that when the CCAR results come out mid-year. So it's really two fronts on the regulation front that we expect to see banks to benefit. But maybe a little bit jump the gun in terms of share prices and the expected benefit, again, just not accruing until late this year or early next.
Okay, so you've got a buy rating on Goldman Sachs, target price there, $660 per share. You also like a regional bank, MTB, also buy rated, price target of $225 225. It's a regional that is based in Buffalo, New York, and does business in a number of mainly northeastern states in the U.S. Why do you like M&T?
So M&T is has the good service territory. It's also a bank that has consistently good financial metrics for banking. That would be on the efficiency ratio, their lending growth, and the other financial metrics that are pretty strong. So they do have a good service territory. And the takeaway from the results reported this morning were particularly, I thought, the credit quality with a market improvement from the prior year was noteworthy. Keeping credit costs low into this environment is going to be very important for these banks, and it's sort of counter to what we've seen recently from the aggregate data from the Federal Reserve, which is that these 60 and 90-day past dues for credit cards, for example, are at a 12-year high. We've seen auto lending with some default rates and repossessions going on there. So if you see a bank that has markedly improved credit quality in this environment, it means they're doing something right relative to what the rest of the industry is facing. So I think that's certainly a positive for M&T. And in fairness, the target prices you mentioned were set prior to all this tariff turmoil. So we'll be taking a look at those. But still, two strong banks here, and particularly if you're looking for a regional bank that has good, it's not trading at a premium, and we think it should be, that has good dividend. Most of these banks that I have buy ratings on are 3.5% and 4% plus in terms of dividend yields. That is favorable, and that tends to be a buy spot for regionals.
Stephen, thanks a great deal for a good conversation on a couple of names in the U.S. banking sector, including the big one of the day, Goldman Sachs. Stephen Biggar, Director of Financial Services Research at Argus Research.